Just in terms of the return of volatility, is it something to be worried about? What's causing it?
Well, if you own stocks like you'd own a farm or an apartment house, you don't get a quote on those every day or every week or anything. You look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them.
Like and the volatility index and things that are tied to that.
The idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now, they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the Buttonwood tree in 1792 or whatever it was on the exchange. So, but if you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or McDonald's franchise, you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like, an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling form of activity.
Although you've said yourself, you talked about this in the annual letter over the weekend, and just even at the top of the show, where when you look around for a business that you want to buy, you can't find any at attractive levels. However, when you're looking at equities, you do see that as a good place. That Berkshire has been a net purchaser of equities this year in 2018, and that's because you like the deals that you're getting in the market.
You can buy small pieces of businesses for less than you can buy whole pieces of businesses.
For the premium you'd have to pay if you were buying the whole thing.
Yeah, so you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. And that's the way I look at my own stock. That's the way Charlie looks at his stock.
Part of the reason that you've been so bullish on equities for many years at this point is the interest rate environment. Yeah. You've looked at interest rates and said interest rates are gravity on stock prices, and when interest rates are so low, stock prices inevitably are going to climb. There's been this really weird thing that's been happening in the markets where all of a sudden good news that we got from a good jobs report made people start to worry that interest rates were going to climb and that the Fed was going to raise rates more than anticipated. People got really nervous around that, and you can still see it every time we get up on the 10-year back towards 3%. It gives investors, or at least traders, I should say, some concerns about what's happening. How do you kind of gauge all of that?
Bond, if you buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days, it does now, it's electronic. But it has a whole bunch of coupons. The coupon says 3% or whatever it may say. And you know that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet. And it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity, if they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons. And it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
Investing, successful investing is all about. And the first point is know what you own. I can't believe how many people own stocks and they couldn't describe to an 11-year-old in 2 minutes or less why they own this thing or what it is. If you actually pin them down and you put a whip to them, they'd say the sucker's going up. That's the only reason they have for, and this is the normal kind of company that people buy. This is a very simple story. I own a lot of companies like this. They make a relatively mundane product. It's a 1 megabit SRAM CMOS bipolar RISC floating point data I/O array processor with optimizing compiler, 16-bit dual port memory, Unix operating system, 4 Whetstone megaflop polysilicon emitter with a high bandwidth, that's important, 6 gigahertz double metallization communication protocol, asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, token ring interchangeable backplane, and they do it in 15 nanoseconds of capability. Now, if you own a piece of shit like that, you will never make money, never. Somebody come up with more Whetstones, less Whetstones, big mega flop. I mean, what do you do if this thing goes from 12 to 9? Do you buy more? Do you walk around the block? I mean, do you call your friends? I mean, what the hell do you do with something like that? People buy this stuff. I mean, I buy stuff like Dunkin' Donuts and Stop and Shop and CVS and made money in all those. And Sally Mae was just here, right before me. I mean, it was a stock I bought that they had a great name. It was Student Loan Marketing. I mean, who would ever buy anything like that? It was a great name. If you heard the story, I think 100 people heard the story. In fact, I had dinner last night with Al Lord and Ed Fox and Paul Carey. We're all in that roadshow in 1983. I think if 100 people looked at Sally Mae, they would have bought it, but 100 people wouldn't look at it because imagine loaning money to students. Imagine doing anything with students. And it was a great story. It was simple, and no one looked at it. So that's the kind of stocks I like to buy. But I'm telling you, people don't do this. And I'm talking sophisticated people, unsophisticated people. They don't know what the company is, what's the story. And it's very important to know it because it doesn't always work, and you have to keep posted. Now here's a big point. Remember this one. It's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we're going to have a recession. I'd love to know when interest rates are going to go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. Unfortunately, you don't get it. I remember in 1982, we had a lot of people in this room around for 82. We had 20% prime rate, 15% long governments, double-digit unemployment, double-digit inflation. I don't remember anybody telling me about that in 1980. I remember everybody telling me about that in 1981. But in 83, I remember they said, well, the economy's bounced back. We're in a recession in 85. In 85, they said we have a recession in 86. In 87, something happened in October 87. I forget what something happened in October 87. Celtics lost 7 in a row. Something bad in 87. They said for sure we'll have a recession in 88. And they said 89 for sure we'll have a recession. And then 90, we're supposed to have the so-called soft landing, which we never had. So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. And all you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, if people are building too many hotels. I look at freight car loadings when I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. You might as well call the psychic hotline for that stuff to get a better average. You got plenty of time. This is true of Sally Mae, it's true of Dunkin' Donuts, it's true of Stop and Shop. People are so insistent, I'm that way too. I have to fight it. They have to buy a stock, let's see, it's now 501. I haven't found a stock yet today, I gotta find a stock before sunset, You could buy Walmart 10 years after Walmart went public. Let's say you're a very careful investor. You waited. You said, I don't know if this company can make it. You waited for Walmart to roll it out. You could buy Walmart 10 years after they went public and made 30 times your money. 30 times your money. 10 years after they went public, they're only in 15% of the United States. 1.5. They hadn't saturated the 1.5. You could say, well, why can't they go to 17? Why can't they go to 19? I mean, why don't I take a leap of faith here? Why can't they go to 26? All they did for the next 3 decades was roll it out. You could buy Walmart. If the day they went public, you bought it, you would have made 500 times your money. If you waited 10 years in Walmart, you made 30 times your money. You got plenty of time in this business.
How do you know? You've always said that you should sell when the herd is happiest and buy when it's gloomy. How do you know when the herd is gloomy that it isn't right?
Sometimes they are. And of course, we make hundreds of mistakes all the time. But we have found, from the very time we started our investment council operation 44 years ago, we published as the motto of our business to buy when others are despondently selling, and to sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Now, this applies not only to stock market cycles, but it applies to particular industries and types of stocks. Basically, we determine that by finding out what is selling at a depressed price. If a stock is selling for a quarter or a half of what it's worth, then it is a bargain and is, in most cases, unpopular with other investors.
Mainly, you like to buy companies that are out of favor. For example, I noticed that your biggest position is in Royal Dutch, but everybody's expecting oil prices to go down. Doesn't that bother you?
Oh yes, of course it bothers us, but there's so many other factors. We do own a very large amount. In fact, I think Royal Dutch Petroleum is the largest holding in our mutual funds, because at the present price, it's selling for only 4 times what we think it will earn this year. And we estimate that in the long run, it will earn more. And it's selling for less than half what it could liquidate for, and only about 3 times its present annual cash flow, and pays a good dividend. So for many, many reasons, it looks like the best bargain in the energy industry. It's very widely expected that there will be a decrease in the price of oil, and if the low point for share prices is when the most investors are expecting bad news, not after the bad news comes out. Now, it is possible that it might get lower, but we are long-range investors. Our average holding period is 6 years.
6 years.
So in the long run, it'll be worth much more.